Hey, today's episode of America's. Sorry, I'm in the mood, right? Or I'm on a roll with America's favorite traders. We had Jared Levy on the show. His new book, Your Options Handbook, is going to be out March the 11th. Please be checking the website. We're going to try to get that America's favorite traders episode up on by Friday, which is tomorrow. So we're going to be working on that tonight. Okay, to the trades that you need. Molly Corp, MCP. We have started taking off our March 50-55 call spreads on Molly Corp. We're actually up north of 50% on the position, and so we did take roughly about 25% of that position off today. The stock's down it's floating around, down 30 cents, down 90 cents. It has been down close to $2 during the day, so since we've kind of seen the rocket ship tail off a little bit, we've started to sell out of those. We sold them for $2.40 for the 50-55 call spreads, and like I said, we bought them for $1 something. So we're up quite a bit. We still have a healthy position on, but in this market, you try not to look a gift horse in the mouth, right? Okay, we've also started to add to our General Motors position. There was some weakness in General Motors, and so we went out to the January of 2013 20 strike calls for $17.75. What I like about the calls is GM trades at, let me see if we can pull up what GM is trading at. GM trades at $35.57. We're along the 20 call out to 2013, so we're talking years, right? Almost 2 years of a position for that. $1,775 is what we paid for it. Well, if you take the $17.75 and add it to the 20 strike where we're long, you're looking at $37.75. With the stock trading at $35.50 or so, we're only paying $2.25 for 2 years worth of time premium. So the decay on this option, should General Motors do absolutely nothing, right? Our worst case scenario, should they do absolutely nothing, is to lose $225. That's pretty low capital at risk, considering you have to pay about double that to get into the 100 shares of the actual stock. So we like the January 2013 20 strike call. Is very little bit of time premium considering how deep in the money that we are. So that's a nice conservative way to play it. We're looking at A123 Systems. There was an article about private equity and the auto industry and some of the work that's been doing in the battery area. Ideally, we'd like to get A1 $5 calls or 5 strike calls for $5. We're sitting out there waiting around for somebody to fill our order. Who knows if it'll get there. The stock is roughly near $10 a share, and at the 5 strike, if we pay $5, we're really getting it for free, right? There's $5 of intrinsic value, and we'd be paying $0 for time value. So more than likely, we're gonna have to move our limit up in order to get those A1. So remember, the ticker symbol is AONE, A1 like the steak sauce. The company is A123 Systems, and they've got a deal right now to provide General Motors with some batteries that will be multiple times more efficient than the Chevy Volt, right? So that's what they're looking at right now. A123 Systems has been a very difficult name to own, but again, being so far out of the curve and so far in the money and basically paying nothing for time value, if we can get it, the 5 strike calls at the January of 2013 are what we're interested in for A123 Systems, ticker symbol AONE. The other things that we've looked at today have been CMI. Sorry, I'm going to have to wipe my nose. I feel like I'm going to sneeze perpetually, so I'm trying to get that to go away. Jim Cramer does it, right? So we can sneeze on air if he does, although apparently no one else in media does. So what we like in Cummins, CMI, is to be, I think we've got a call spread risk reversal at the January 2013. We're 95, 105 call spread, and then short the 85 strike against it. I think we paid $2 for this. I'd have to go back and look. Actually, we paid $1.25 for it, and it's a 100, 105 call spread, and then we sold 195s against it. I think we have a call spread risk reversal. I'm going to have to go back and look at it. Sometimes when your book is big and there's multiple accounts, sometimes positions can get lost. But the ultimate story for CMI is that we're bullish on it. So in this instance, we're looking at buying 2 CMI 100 105 call spreads long, and then selling 5 195 put spreads against it. So again, the pivot point is that 100 strike. We're short the put spreads, long the call spreads, and then it costs us $125 to put it on. Max gain obviously is $500 times 2 for the long call spreads, and then the money that we took in for the put spreads, right? So ideally, this trade would be worth $1,000 at expiration, and we paid $125 for it. That's quite a rate of return in terms of making $125 turn into $1,000. So that's where we're looking. Just so you know, the stock is trading at 106 right now, so that 100 105 call spread is completely in the money. And then there is some risk. Obviously, we're only $6 away, $6.25 away from the CMI put spreads where we're short. But again, it's a 5 contracts or 5 spreads is not a terribly large position, and there's plenty of time and room and interest to be able to roll these down and out. All right, I finally found the position for Cummins that we were looking for. Let me get you the stats on this thing. CMI. Okay. So for March is where we have the 2 long call spreads, 5 short put spreads. Okay, 2 long call spreads at the 100 105, 5 short put spreads at the 195. Then out to January of 2012, we have the 90 105 call spread. So we're long at 90, short at 105. Okay, again, completely in the money, and then we're short again at 85, but that's a put. So if for some reason Cummins declines $21 a share and goes from 106 to 85, well then by golly, at that point, at that price, we'd be looking to get long it. So we're short those puts. And then to capture the upside, again, if the stock does absolutely nothing and it just goes to, it just stays where it's at, above 105, then that spread, that 90 105 is a $15 wide spread. We paid $2 for the structure. So we're going to risk $2 and possibly owning Cummins down below 85, and then in exchange for that, there's $15 of upside, right? So the max gain is $1,500 plus or times 2 for the amount of structures that we have. So the max gain is $3,000, and we've risked $200 to do it. Obviously, on a percentage basis, that's a terrific looking trade from a risk-reward basis. Okay, so Cummins. A123 Systems, if you can get the 5 strike January 2013 calls, you could probably go out to $5.50, right, to pay for those, because that's really only 50 cents for 2 years worth of time frame. And if the deal between General Motors and A123 Systems on this power enhancing, storage enhancing battery technology that A1 is working on works out, you'll be the beneficiary of that. Also, we want to play the other side of that with GM and get long the January 2013 20 strike calls on GM for $17.75. It means you only pay, just over $2, $2.25 for time value. The rest of that is completely intrinsic value. It's a great low-cost way to play General Motors. You don't have to pay $3,500 for a round lot. Pay $17.75 or $17.25 for the right to own a round lot. All right, so hope that helps. Thanks for tuning in again today. Be on the lookout for Jared Levy's America's Favorite Traders episode, and we will see you tomorrow. Oh, and we're obviously in the Packers shirt so that we can support the Pack. So hopefully they do extremely well in the Super Bowl on Sunday.